Welcome to mine and Helen's little presentation on behalf of Woodshires, of which I'm the Managing Director. And all I'm going to do is try and educate you all a little bit about tax allowances that relate to property, and there's a whole range of them and how they can be done wrong very easily. So I'm just going to rattle through them bit by bit. The first one I'll natter about is a thing called capital allowances, which is a tax allowance a lot of property people may or may not know about. And it's anything in a property except the bricks, basically, is a simple way I explain it. It's basically for commercial buildings as opposed to residential. There are crossovers, so buy-to-let properties are residential, but house of special needs, which is where there is a resident in place and it's sublet to councils, that's different. But anybody that owns a commercial building and has paid over £250,000 for it, it's worth talking to them about getting somebody involved on capital allowances because it's worth money. It could be worth between 10 and 50% of the price of the property as a tax allowance that gets offset against the owner of the property's tax position, be it a corporation or an individual. However, there's some slight changes in the rules in 2014, which is a few years ago now, where the only person that can use the allowances are the seller of the property who has owned the property from before 2014. There are exemptions to this, which is why I need to talk to most people, because non-taxpayers are exempt. A non-taxpayer might be a council body, a government body, charity, pension fund, anything like that, because they do not have tax liabilities. So they're exempt from claiming, but they can pass it on to the buyers, the buyers of property. They are basically in simple, I'll give you some examples here, so I'm trying to rattle through it fairly quickly. Basically, the allowance that we're talking about is what I call consumables within the actual construction of the building. Not the bricks and mortar, but actually things like wiring, plumbing, toilets, sinks, basins, kitchen, anything that is bolted into the building. An easy way we describe it is if you turn a building upside down, everything that fell out with an office or a pub or a hotel, everything that fell out has already been claimed as a capital allowance. Tables, chairs, computers, all that equipment. But then if you go back around again now with a hammer and a screwdriver and a pair of spanners and things and take everything else out that you can, strip it out and put it in a big pile in the middle of the room, that's the stuff we're after. And you'll find it's things like wiring, plumbing, heating systems and all these bits and pieces. It can be worth a lot of money. Hotel could be 50% of the price of the property as a tax allowance, very useful. Some quick examples and some of the problems encountered in recently because of it. 2 small office blocks bought in 2017 for about 1.3 million. IT recruitment company, funny enough, they were doing the purchasing. The lawyer said there's no valid allowances and they were just taking the answer from the seller. We've got no allowances to pass, forget it. Further investigation by myself and a few other guys revealed that the previous owners had no right to claim. It was actually a pension fund, and prior to that, it was the BBC. So therefore, we turned that declaration upside down and got it agreed that the buyer could file the claim on behalf of the seller and get it transferred. And he got £306,000 of the tax allowances, which was worth 120 grand in cash to him. Again, that would have just normally gone through the wayside, except we managed to get him talked about. Another one, a warehouse. This was a purchase from a receiver in 2014. The selling lawyer said that, again, no valid tax allowances. Further investigation proved that the sale, they'd done a sub-sale prior to going bankrupt and ended up with the receivers, which we actually reversed with the help of the lawyers and the receivers. So therefore, the original owner then owned it again, and because they owned it before a certain period, there was integral features which could be claimed by the new buyer, which he did, and he got 110 grand worth of tax allowances. That took me a bit of time to work that one, but we got there in the end. Number 3, office purchased in 2019, very recent transaction. As part of it, the seller kept the allowances that were already in the property, but there was a £1.8 million fit out as part of the deal. And within that deal, we managed to get written in that the fit outs would be retained by the buyer, which meant he got the tax allowance for it. Well, that tax allowance was worth roughly half the price, £998,000 tax allowance. Probably worth 180 to 250 grand to the buyer. So they're always there, the capital allowances. They are complicated. It's something I've been dealing with for 15 years, but it's only, remember, it's only on commercial buildings. Very complicated. Stamp duty. This is the one that is an absolute minefield for a lot of people because it transpires all over the place. What is stamp duty? Well, we all know it's a property transaction above 125,000. Normally, it's currently got a relief of $500,000, as we all know at the moment. What's the problem with it? The current research shows that upwards of, I've lost a bit on the screen here, there you go. Upwards 25% of all SDLT transactions in the UK have got errors. The main reason for this is that the calculation is done by a lawyer. And of course, lawyers are not tax experts in their own world, and it's not just about property, it's about the personal tax position of the buyers or the sellers as well. Why has it happened? Because of additional reliefs and rebates brought in by the HMRC to make these calculations even more complex. If I was to tell you that the 3% surcharge actually has 32 reliefs around it, so you don't pay it, and the revenue don't tell you about any of them, unless you know how to get to them. The problem is the lawyers have been lumped with the responsibility of doing this. There's nobody else do it. Accountants run away from it. Nobody else can do it. However, I work with a specialist who is a specialist who lectures lawyers, so we can help. But remember, stamp duty is not a simple transaction. It's a lot more. We can help people with it. But remember, anything above $500,000. Now, anything below $500,000, you've already got a relief. But we can go back 4 years on it. Some examples of where this is wrong: residential property purchase in the name of Mr. and Mrs. K. They paid £2.8 million for the property. They paid £197,000 for the stamp duty. On reviewing the transaction, it's subsequently refiled it because the property was mixed use. An example of that, to give you an idea, anybody buying a property above $1 million probably isn't just buying a house. There'll be land, there might be stables, paddocks, a granny annex, something else attached to it, rights of issue, all sorts of different things. As soon as that applies, it's not wholly residential. You've now got a mixed transaction. So when it's a mixed transaction, you've got mixed rates that are applying to different segments of the property. And this is where we get involved in it. In that case, the client's got 85 grand back off the tax man. Once it was refiled, you can refile in 12 months very easily. Beyond 12 months, the revenue like to argue everything that they can because they don't like to pay. Taxpayers get shortchanged. Other example, industrial estate. And this is a really interesting one. It was a Mr. and Mrs. H, and it was actually purchased in an LLP. 1.2 million. It was advised to pay the full duty, and duly did so. Upon investigation, there was actually a clear link established between the sellers and the purchasers. In fact, one of the purchasers was the daughter and actually a shareholder in the company that sold it to the LLP. So actually, because there was this clear link of lineage between parties, there was no SDLT payable. So we got the refund issued back to them for £42,000. Very pleased indeed. But again, the lawyer wouldn't know that. They'd just go, you're buying a £1.2 million property. They would not look into the tax positions of the individual owners and the links between all the parties. And that's where that one went wrong. Another example, company was buying a purchase, property being acquired, was advised at a 15% rate. Taxpayer was £126,000. On investigation into the actual property, it was revealed that it was in a trade and it was a mixed-use property as well. So actually the 15% rate didn't apply because of a mixed-use property transaction. So they got a £94,000 refund against £126,000. Again, it's another area where it was not just about property, it's about what the property is used for and everything else. It's very complicated. So number 4, a residential development purchased by a PLC. £1.7 million purchase, taxpayer was 82 grand. On investigation, it's confirmed the development was multiple dwellings, not one. They got £62,000. If it's multiple dwellings, the stamp duty gets applied to each dwelling in its own value as opposed to the lump. In fact, this was the first area where my expert and I got involved in because he was helping a lot of high net worths mitigate their tax liability in the UK as they were offshore owners. And what happened was one lawyer, the guy had bought a whole street basically. It was one transaction off a development company and they bought the whole street, 15 properties, and it was like £30 million. It was a huge one. But the lawyer had put it down as one transaction, so the stamp duty was absolutely huge. And my guy was helping him do the tax break on it. He suddenly realised that it wasn't, it was multiple properties. And the lawyer hadn't applied it in proper, duly got the tax down, huge amounts, but he suddenly realised there was a problem. So we started looking into it. And me being on capital allowances, this is where I know this guy from, because of my expertise in the capital allowances, we started to talk together. We realised that there's a lot of transactions that are actually wrong. If I tell you it's actually more than a quarter of all property transactions that are paying SDLT are probably incorrect because of all the reliefs and everything else, it suddenly is a big minefield. And if you actually sit in front of a lawyer and ask them, do you like doing stamp duty? I think about 99% would say they hate it. Can you sort it out for me? And you'll also get the same if you talk to accountants and financial advisors. They'll all come up with the same thing. It is so complicated, they don't want to go anywhere near it, but they just end up having to do it. So I'm offering a solution to this, which we can talk about later. But I'll give you another example. We realised that because of various links between parties in capital allowances, there's actually an error that's occurred relating to stamp duty and pension funds. So we duly sent off a load of documentation to the Inland Revenue to say, are we correct in this assumption? And they came back and said, actually, yes, you are, which basically means in certain circumstances, if you're moving a property into a pension fund, you don't pay stamp duty on the transfer. So we duly then sent that question out very specifically to the top 15 lawyers for stamp duty in the Golden Circle, which is basically the top lawyers in London. The same question, and out of 15, only nobody got it right. All 15 got the answer wrong and sent the answer back. So it's a huge minefield. Even the experts get confused about it. We work with somebody that actually lectures on the subject and he's prepared to challenge the revenue. But all I'm trying to educate you guys is that don't always believe a lawyer. Question, 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 get more advice. Lawyers are only humans and they can only rely on the information they've got, and they're not experts in tax. Property tax is huge. I mean, I've just talked about two for starters. I'm going to go on to the next lot now. The next one, would you believe, is a research and development tax credit. How the heck does this apply to property? You'll be surprised. R&D tax credit is a very, very broad tax allowance, and anybody who is a limited company is eligible to claim it so long as they are adapting new or existing products or services. This is where it starts to go physically intellectual. So I'll give you some examples in a bit of associated businesses within properties that can apply for tax credits. It's valid for anybody that has the last 2 open tax years of a limited company, so you can go back 2 tax years. When should a client apply for it? Well, as soon as possible if you'd like to get some money in the bank. Simple as. But I'll explain more in a minute. Where is the benefit? R&D expenditure gets a tax uplift of 230%. So if you spend 100 grand on something that qualifies as R&D, which I'll explain more in a minute, then that gives a tax allowance of 230,000. As a corporation tax, that's actually worth £46,000 in corporation tax reduction or cash. So you spend 100 grand and you get 46 grand off the tax man. Now you can see why people like to claim R&D tax credits, because it can be worth a lot of money. We work with people with 100% success rate. We've been doing this for 6 to 10 years now. It's a substantial tax refund, which is cash. It rewards businesses for development and growth and increases their cash flow. As you can imagine, during COVID, we've had a few inquiries. Where does it apply in the building trade? It's on the peripheral areas. So let's give an example. A window and door manufacturing company, they design and fit windows and doors. Double glazing, to be honest. Simple. But it's never that simple when you actually talk to them. They turn over about 1.5 million, but elements of what they do is always challenging. That's what we look for, the challenges. Nothing is simple. They get 23 to 28 grand in cash off the tax man in the last 2 years. So very nice work for them. Client number 2, this is a plant and machinery hire company, would you believe? So they actually just rent diggers and tractors and bulldozers and all the other bits of equipment. Never claimed, didn't understand that they could, and no idea where, but they wanted to borrow some money to pay off one of an old director and get rid of him. So they asked the finance company, asked if we could get involved in the R&D, was there anything there? When I got talking to them about what they actually do, they were adapting some of these diggers and bulldozers to do very specific digging and bulldozing jobs in specific areas within the, it was in the building materials basically. So they were digging out sandstones, limestones and other materials. They were adapting machines to do it. So they ended up getting 2 tax rebates worth £50,000, which actually paid off the director they wanted to get, and that was a cash refund from the tax as well. So it's just an associated industry. Architects' practice. Who'd have thought an architect's practice can actually claim R&D? It's in the design work of the building. This particular practice, they design buildings for the NHS and fire brigades. They actually create specific rooms within structures for specific purposes. Turnover about 3 million. Their R&D is in the design of the solution to a problem. The problem is they want to create a room that you can make on fire and actually burn the rest of the building down. So they have to come up with a solution there to create it, make it safe and all the other bits and pieces, and then actually write out all the plans for it. And like I always say, architects can't claim for the bricks and mortar, but everything else that goes into it to make the building work is probably an area of technical advancement. It isn't that simple when you actually think about it. How the hell do you make it work? They get £146,000 a year in tax reduction or cash refunds from the taxman just by doing building designs. Not all architects can claim, but it's always worth a conversation to see if you can, because it's money in the bank. A lot of times, like I say, it's not simple. R&D is about challenges. It's about errors. It's about solving problems, uncertainties. So last one, office design and fit company. All they do is somebody comes up and says, I've got this space, can you make me this wonderful place? Which you'd have thought no R&D, but when you actually talk to the guys, there's a lot of technology goes into this to make it work. How does it work and function? So they turn over about 3 million a year, £40,000 every year in tax refund or a tax rebate reductions for doing what they do. Just, I'll touch on other areas that, again, within the construction sector, there's a thing called land remediation relief. It's a specific relief for anybody that is remediating land, such as brownfield sites. It qualifies in demolition, things like knotweed, any kind of contaminants, asbestos. If you or somebody has come across that they have to spend a lot of money to get rid of this rubbish and take it away, then that starts qualifying as a tax relief. In addition, and I'll give you an example, this is in addition, there's a guy that we worked with who owned a football club basically, and he leased the buildings and the land off the council, and then he wanted to develop it, so he did a deal, and they said you can develop it, but you've also got to develop the land around to create training grounds. So he said, I'll do that, started digging down into the ground, suddenly realised he'd just come across a 1950s landfill site. So he then had to go down 2.6 metres, dig out 15,000 trucks of muck, take it away, get it regraded, sorted, brought back in, decontaminated and put back into the land, regrade the land, cap seal, put grass on the top so it could be a training ground that was safe. He spent about 1.5 million, but he had a tax bill to get rid of about £180,000. We got rid of the tax bill and we also gave him a tax refund based on land remediation relief and R&D just for digging out the land and putting it all back again. So land remediation, again, it's another area that gets lost because it's not that easy to spot. And then the new one, which is for anybody that is building a building of a commercial variety or extending a building commercial variety. Traditionally, you have, or recently, you have not been able to write off the structure against tax. It just sits as an asset. There used to be an old tax allowance called industrial buildings allowances, but they've restructured it and brought it back as structural buildings allowances, which now means you can write off 2% of the cost of the building against the tax of the owner of the building every year. Again, it needs a short report doing to actually identify it. And again, that's something that we can help people with. So in essence, we're talking about capital allowances, stamp duty, R&D, land remediation and structural building allowances. as allowances and tax allowances that property and property owners need to understand about, and every one of them is complicated, so you actually need a specialist to do it. So that's where we sit. We're a consultant in these specialisms. We've been doing it as Woodshires as a father and a son business since 2014. I did 7 years or more at capital allowances before we started the businesses. My son's been 10 years or more in financial services. So we have a lot of experience and wealth with us to be able to help you guys, which is what we do. We can talk in up to actually 14 tax allowances now. And today we've got thousands of clients with thousands of claims. And in essence, we are helping our current portfolios to actually get a cash benefit in excess of £500,000 worth a month. And that's growing every month as we talk. That's all about me. 20 minutes and 45 seconds. Any questions, talk to me afterwards. There's my email address and phone number if you want to talk to me. How's that, Mark?
Excellent, mate. Right, that's good. I mean, sorry, apologies, I had to go out and had a call, but from what I saw, I've got the advantage that this is all recorded, so I should be watching it again afterwards, and I'll pick up.
Oh no, don't hold me to it.
So there is one question I know. Vicky, do you want to take yourself off mute and ask the question, because I've asked the questions in the past and then they're not asked properly. So
I did answer Vicky's question, Mark, but yeah, that's fine.
Apologies.
Sorry, Helen. Sorry, I've had to nip away from my desk and come back, and I wasn't sure if anybody had answered it. So sorry, Helen. But yes, thank you. Thank you both, and thank you for the presentation, Paul. It was excellent. It was just basically, I'm in HMOs, and I'm just about to buy a portfolio, and I wondered how HMOs qualified for multiple dwellings relief, basically, if they did at all. But I'm just looking at Helen's message now.
Okay, yeah. I mean, HMOs, multiple dwellings, no, it's a single residence basically.
Yeah.
However, HMOs do qualify for capital allowances. It is a grey area. If you're going to buy a portfolio, get in touch with us. We'll give you some advice in the background.
Well, thank you for watching the presentation. I hope you enjoyed it. Third Monday of every month, we get together for a network meeting, and we have 3 speakers. If you'd like to present at one of them, please let me know. All my contact details can be found at the end of this message. Hope to see you soon.